What's making headlines? Your weekly wrap-up of the biggest news stories in the Australian mortgage and finance broker market.
Hello and welcome back to What's Making Headlines. It's Annie, Ben and Charlie here with you unpacking the big news of the week. How has your week been, Charlie? Good week?
Yeah, it was good. I think we've crammed a lot of stories into the week.
Lots of stuff happening.
Yeah, very busy, that's for sure.
Yeah, and Ben, for you as well. So busy week. You've been here, there and everywhere.
Busy week. Yeah, it's rate call week, so that's always a busy week for us. Plus results from two major banks.
Yep, we've been really pounding out the word count this week. Yeah. But of course, big one, the rate decision for May came through on Tuesday when the Monetary Policy Board of the Reserve Bank of Australia announced that rates, shockingly, not so much, were going up, but shocking for a lot of borrowers because obviously this takes the official cash rate to 4.35%, back undoing all of those rate cuts we had last year, and now back to 4.35%, which at the time when we had it in 2025, I think it was in February, when it was last around then. February 2025. That was the highest it had been for over a decade. So we're back up at that level again. People feeling, though, this time round might be a little bit tighter because, of course, costs have gone up since then. You know, petrol prices, inflation's going up. So this time round, 4.35% might feel a little bit worse than it did last year. Charlie, you were covering all of the coverage of the RBA this week and were listening to Michelle Bullock's press conference afterwards. What was the go? What did you think? What happened?
Well, it was quite a interesting press conference from Governor Bullock because she talked about a lot of things. And I think the last decision, she was kind of rationalising the decision a bit more because it was more narrowly split. 4-5 this time. I think there was more of a consensus there. It was 8-1. So I don't think she felt the need to kind of argue the case as much. However, she said a couple of things that were pretty interesting. She described the current rate as a bit restrictive, which I found interesting, and I think a lot of the banks read into as well, of getting an indication of the thinking of the leadership and where they think the rate.
And need to cool things down a bit,
Yeah, but also them thinking that it's providing them with a bit of cover and a bit of space to see how things are unfolding in the situation in the Middle East, and the RBA thinking that, well, now they've perhaps got a bit more coverage to wait and see with a bit more finality. So she said the current rate buys them space and provides them with space. To see how things continue to unfold. And a lot of the banks read into that a bit as thinking that, well, maybe the RBA is kind of more comfortable with rates than we previously thought, type of thing.
Yeah, and I think the other thing is, of course, you know, she was sort of talking about the fact that the reason really for it was the conflict in the Middle East. Some people saying, interesting that she hasn't thrown the government under the bus and been like, oh, you know, there's a lot of government spending coming up. Obviously, the budget is coming up next week as well. So some people being like, you know, well, if they're spending heaps of government spending, which is a really big part of inflation, then why didn't she talk about that in the statement? But she did kind of mention it in the press conference.
Yeah, she did. And she was asked a lot of questions on it, and she basically said that, you know, government spending obviously plays a role here in adding to consumer activity. And she kind of indicated that when you have these elevated inflation pressures and also cost pressures from this ongoing conflict in the Middle East, it's not preferred that the government hand out even targeted subsidies to households and to consumers to weather the shocks, because, you know, theoretically that's going to increase spending.
Yeah, which is still pretty high.
Yeah, it's still up at a time when inflation is high as well. And she said governments need to be conscious of the decisions that they make. And she kind of went that, she said governments are spending a lot of money and we're running up against capacity pressures. Then they need to think about whether or not there are ways they can help the inflation problem by looking for ways to constrain demand. So there's no messing about that comment. That she's it certainly came up, I think, in discussions among the board of government spending playing a role here, or it can, with the budget coming, it could play an even greater role as well.
And 8-1 is a pretty comprehensive decision, but did you give any indication as to what the what was behind the dissenting members' thinking?
Yeah, she was asked a question specifically on what was the intention behind the member who voted against the decision to hike, and she basically said they were putting more emphasis on the wait and see, waiting for more data to come in, seeing what the impacts of hikes would have on demand and consumer activity, because obviously we've seen those shocking confidence and sentiment surveys that are showing that, you know, people aren't confident about anything, or in fact their confidence has collapsed in regard to, you know, incomes and living standards, and that their expectations about rates are really high.
Well,
and she's concerned about that.
Yeah, and I think this is really interesting because we keep hearing about this, not only from a consumer's perspective, but also from a business perspective. That sentiment is so low at the moment.
Yep.
But as we said, like, unemployment's still really low.
Yep.
Loads of people in their jobs, even with the spectre of AI potentially, you know, threatening everyone's jobs. That is something obviously a lot of people are concerned about for later on this year. But I think people are still in jobs. They're still spending money. We keep seeing the household spending data coming out from the ABS and from the banks being like, people are spending a lot. And not just on essentials like discretionary spending.
Yeah.
But do we think a few months down the track, sort of metrics like that will start to, is that when we'll start to see the impact of these rate hikes on metrics like that?
And so this is exactly why the RBA is like, we need to increase the rates because people we're not really obviously in restricted territory enough because people are still doing all these things. The flip side of that though is some people saying, is this going to push us too much? Because if we have more rate hikes, do we risk putting us in recession? So, you know, kind of looking at what was happening in the actual kind of growth aspect as well in productivity and in GDP and all of that good stuff. And I'm sure we'll have lots to unpack next week after we've had the budget from the federal government handed down and seeing what's in there, whether or not the CGT and negative gearing changes will be in there, which has been rumoured to be coming up, whether or not the instant asset write-off will be made permanent. That's a big one that we get pretty much every year now. People saying, can we please just make this permanent rather than rolling it through each year? It's very annoying to have that uncertainty. Other things that we're expecting to see as well are potential more stuff on housing that we don't know about yet. So we'll obviously be keeping everyone posted. But I think the future trajectory is what everyone's got in mind. And I think perhaps Michelle Bullock and the RBA Monetary Policy Board were thinking about the budget and being like, maybe there will be some more spending in here. So perhaps we should take a step first to start cooling things down a little bit. I
think she's also conscious that you were saying, Ben, that there's a delay in every action that they have. And her stressing to the media pack that the full effects of this war won't be manifest for 6 months, and that rates themselves have a pretty lengthy drag on period too for them to start slowing demand too. So she basically said the true economic impacts of this war won't start to unfold for about 6 more months.
Yeah, well, I think if you think about it as well, like, you know, we had, I think, reading elsewhere in mainstream media and sort of like listening to economists, like we had quite a lot of fuel and oil already in Australia. It takes about a month for the kind of supply issues to actually filter through, and you know, there's been some boats coming through the Strait of Hormuz and there's been some kind of stop start. So I think now that it's kind of been over a month, this is we're really at the beginning of seeing some of the tightening, and that's why, of course, the government brought in the fuel excise. The thing that we're seeing though now is saying, well, what happens next? And the banks already have been reviewing their forecasts. We've had changes to the major bank forecasts. I think, was it NAB?
NAB, yeah. So NAB was the only one to change their forecast. So before the hike, you had ANZ, NAB and Commonwealth Bank saying that May was going to be the only 25 basis point hike and this year, and that Westpac was the outlier, flagging 2 more in June and August. But after the hike and after the monetary statement and Governor Bullock's press conference, NAB has come out and said that they now see a hike in June
Boo.
Yeah, I know. Not good news, obviously.
And then 25 basis point
for borrowers,
hike.
25 basis points.
So that would take us to 4.5.
Yep, and they kind of they explained the reasoning behind this shift, and they basically said that the RBA is dealing with a double-edged sword, and it's a unique problem for Australia because inflation was already high before the conflict begun and out of target, and now that you have these pressures coming from the conflict and then the after effects of it are too great for the RBA to look past and ignore. And then the second and third round impacts to other sectors like agriculture and retail and food, that being baked in the economy. And there was a lot of reference to those second round impacts in the monetary statement as well. But they kind of said that it's very finely balanced. And they said,
Of course it did.
despite
Economists.
Bullock,
It could go anyway. We don't know.
Covering their bases, but they kind of said that it's going to be tight. It'll be tighter than May, they think.
Well, Ben, what do you reckon? Do you reckon June another hike?
It's hard to say at the moment. It certainly seems to be the way things are going, but I don't know.
Who knows?
I don't know. It'd be
They
tough.
could be
It'd be
wrong
tough on
because
mortgages.
CBA said May was going to be a finally balanced call, and it was pretty overwhelming.
Overwhelming hike, yeah.
Well, I think,
you mentioned there about, it's going to be quite tough on mortgagors, but borrowers already have a mortgage. And we saw some interesting data come out from Catality, the property research company, this week, talking about, well, what does this mean for people who already have a home loan? So Gerard Berg, who is their head of research, was saying that the average, I think it was average, it might have been median. The average size of a new mortgage in the December quarter, so the most recent quarter we have data for, was sorry, I'm eating my hair.
Right.
Was $736,000, and the pass-through of this rate hike would be about $119 per month for borrowers, or $55 per fortnight. And obviously that's just for this one.
Yeah.
So if we have another one in June, that would be 4 this year.
Yeah.
That's, hundreds of dollars.
When the prices of everything else are going up at the same time too, like how are you gonna? Where do you find?
Exactly, and as we've sort of mentioned, particularly for those who are particularly struggling, those who have to travel a lot for work, if they're like farmers, if they've got a lot of costs going up because of petrol prices and cost of goods as well, like it's going to be pretty tough. I think because of this, a lot of people saying, well, maybe the property market will cool down a lot. We've had quite a strong couple of years of home buying, well, really since the pandemic, pretty much. We've had very strong home buying activity. House prices have been ticking up and up and up as supply's been low and demand's been high. Perhaps this will cool demand for housing as well, which will obviously reduce housing inflation. But that would not necessarily be a bad thing. We have seen, or conversely, we'll just see way more activity in the cheaper end of town, which we've already seen a lot of activity in because of the government incentive, like the first and guarantee schemes and the Help to Buy scheme. So it could just make cheaper properties that much more in demand, because it will be tight. It will be tight to borrow that much money and hard for people to service a loan at 4.35%. If you think about that's the cash rate, mortgage rates will be, what's that, 6.5 ish, and then you add the buffer on top, 9.5% servicing. That's pretty high. Yeah. So we'll probably see borrowing capacity of potential buyers reduce, which will also reduce demand because people just won't be able to get a mortgage. And that's what lots of brokers have been saying to us this week.
Those borrowing capacity, like statistics in anticipation of the hike, were pretty interesting to see, because it's interesting to see how much even a single rise can strip from your purchasing power. Let alone 3, potentially 4 merged into one. It would be hard not to see how this would not have an impact on home prices and demand.
Well, talking about that, Gerard Berg, who I was just talking about at Catality, did the numbers, and he said this hike reduces household budgets, the median income budget, by $18,000.
Wow.
So you're servicing. So he was saying, assuming, you've got a 20% deposit, you're taking out a 30-year P&I loan, he's like, budgets will be lowered by around $18,000. That's borrowing capacity. So That's a lot. That's the big difference for the types of property you're buying.
It makes a massive difference.
But yeah, lots of things coming out from that. And as we always sort of do, you've got the initial reaction from the industry, and then kind of a couple of days later, people being like, well, we've done some analysis now. I've gone away and done some work and had a look at what that actually means the longer term. And I think, now people are saying, well, rate hike, if we do get another one, that's going to be tough on the property market for the rest of this year.
And
but
back to back too, like they're consecutive. There's kind of no break
three in a
between
row,
them.
and then June again.
Yeah, they're going hard and trying not to have the same mistakes that they may have made in the past, as opposed to not acting soon enough, is I think what a lot of commentators are saying now.
Well, hindsight's 20/20, isn't it? But I think looking at what else we've been seeing outside of all the rate changes, that has been the main thing we've been writing about this week. But we have also had reporting season, and we'll get into what's happening at the major banks when it comes to broker flows just after this break. So this week we've had half-year results from a lot of the lenders, including 3 of the 4 major banks, because CBA is on a different financial calendar than the others. And this week, some of the things that I was paying particular attention to was what's happening with broker flows and what's happening with proprietary flows at the major banks, because nearly all of them now have said they're going to be focusing on proprietary.
Yeah.
I think obviously CBA has probably been doing that the longest of the big 4, and we have been seeing their proprietary flows increase and broker flows drop.
Excuse me.
But ANZ's the latest to join the party in saying that. Nino Matos, the new group CEO, was talking this week about their strategy, and he was saying, we do want to be moving towards higher proprietary, and that comes as really broker flows keep going up at ANZ. I think you wrote the story, Charlie, about ANZ early, maybe it was last week actually, wasn't it?
Yeah, it was on Friday.
Yeah.
So kind of back to back, we've had these banking results from ANZ, Westpac, and NAB, and it's
69% now of their new business coming from broker channel at ANZ.
Talking about this proprietary fight back and introducing and having that in their principles and objectives, but then you have the statistics which show the exact opposite.
Well, no, I think this is why they're doing it, because
it's a cause and effect.
Yeah.
Exactly,
Yeah.
it's a cause and effect. Yeah, for sure. But yeah, new broker flows are way up on new business for the half. 69% of loans came via broker, as you just said, up from 67% in the prior corresponding period in the half the year before. And new flows for the bank, proprietary flows were 31%.
Yeah. So obviously, Matos saying, well, we're doing all of this work. They've obviously still bedding down a lot of the Suncorp acquisition and being like, we really want to be increasing our prop.
Yeah.
Yeah, they said they're going to increase the number of lenders in branches up to 50% more over the next 5 years, which is
a
a
lot.
considerable number of
Banker hiring spree.
Yeah, exactly.
And that's what we've seen the others do as well. Both NAB and Westpac also released their half-year results this week, and both of them have been putting a lot of focus into hiring home loan specialists in their branches and being able to encourage more customers to actually book in with these home loan specialists. And that has seen dividends in terms of their proprietary flows. NAB announcing on the media call that I was on this week that actually in March, their proprietary flows hit 50%. That is the highest it has been than I can remember since I've been working on mortgages for the last 10 years. So really high proprietary flows, increasing there. I think over the actual half, it was about 47.7% for proprietary, which obviously means the brokers' flows fell down to, what's that, 53%?
Yeah.
Do the maths in my head. I was like, wait, hang on.
Bang on.
52.3%. So looking at that, I mean, really seeing the NAB strategy starting to change. And what was interesting on that media call as well, I was basically saying to them, well, what is your broker strategy? And they were talking about moving to having more targeted broker relationships.
Yeah.
Now, I did ask CEO Andrew Irvine, what exactly does this mean? Because when I was looking at the investor
Please
pack,
explain.
exactly, I was like, that might not be that interesting to investors, but obviously for brokers, I'm like, I want to know what this means.
That's pretty critical.
And they were talking about saying, a targeted approach really means deepening relationships with valued brokers to drive growth in priority segments. I did also speak to Adam Brown, the executive broker distribution, this week about it, and he was saying it's kind of almost like providing that specialized service, like almost having like a private banking service for our valued brokers, so kind of having, faster kind of decision making and more options available to them. Obviously, I think we'll get more detail as this comes down the line, but for now, seeing that, and I thought that was quite interesting, kind of talking about moving to a smaller cohort of brokers they want to work with. And this is what Andrew Irvine was telling me. He was saying, and I'll quote, "What we want to do is to focus on a smaller cohort of brokers that we can have good relationships with, that we can essentially more effectively service. We'll be focusing on those brokers where we believe that we'll get flows that are closer to our appetite in terms of above cost of capital lending. We really don't want to be doing business where the returns are below our cost of capital. So that's where we're pulling away from slowly and purposefully."
So for NAB, what areas would this be?
I mean, I'm guessing if it's above cost of capital lending, that would probably be self-employed. It'd probably be some of the more complex lending, business lending, I'd imagine as well.
Yeah.
But yeah, I haven't looked at the NIMs on all of their different types of loan products recently, but I imagine that's what they're doing. And of course, as we know, brokers do such a great job of repricing and refinancing borrowers that often that's why the ratios are lower on broker loans, because they're just getting such a sharp rate all the time. They're not making any money.
Yeah, they're great comments from Andrew Irvine, and it's really interesting to sort of see that sort of approach put out there.
Yeah, and the other thing that I think is interesting, I did read on some other parallels being drawn from other media outlets where they were saying, or insinuating at least, that perhaps this move to a smaller cohort of brokers that they know better is part of this ongoing sort of move, not only to reduce broker flows potentially, but actually to reduce who they're working with because of this ongoing mortgage fraud investigations. So there was some insinuations that maybe this is part of the reason why they're shortening and kind of tightening up who they're working with, because there's been some chatter along the lenders around, who's potentially doing what, who's seeing what from whom. And, we know anecdotally there's this list that goes around the major banks about brokers that potentially are not doing the right thing. I've never seen this list. I'd love to. If anyone's got it, send it in. We'd love to see it. But yeah, like supposedly there's a list that the lenders kind of share with the major banks, share with one another, that talks about, who might be doing the wrong thing. And obviously this is part of the big investigation, being like, is there any illegal activities here? Will we start seeing charges coming through from the broker channel? We already had some arrests and referrals, accountants and solicitors. Yet to see any major broker charges.
It's having implications, that's for sure. I think it's pretty hard for the lenders to look past when, potentially they've been lending billions of dollars out of their book that are fraudulent loans that are being being sent offshore for criminal proceeds. Like that's pretty atrocious.
Yeah.
So I think they're just doing whatever they can to try and mitigate that, whether it be CBA's rolling out, new AI systems to spot and sort through fraud, which is a little bit kind of oxymoronical in of itself. However, I think they're starting to clamp down and take a harsher view on things.
Yeah. Just to cover off some of the major bank chat that we had this week, Westpac also delivered its half-year results, and for Westpac, its proprietary flows increased up from 32% to 34%.
Okay.
So really, I mean, NAB and Westpac still having, ANZ and Westpac still having quite low proprietary flows, which is why they're wanting to increase this.
Yeah.
NAB now about 50-50, and CBAs, we know, I think broker flows are down in 30-something.
Yeah.
But that was obviously on a different time period, so we'll have to wait and see what their most recent update says in a few months' time.
For sure.
I think the other big things that we've been talking about this week as well have been, well, what else are we seeing brokers doing? We've been obviously talking to a lot of the associations and the brokers for their reactions to the rate hikes. But we did also hear from other associations this week as some new resources came out, and we'll get into that just after this message. So the Mortgage and Finance Association of Australia and the Commercial and Asset Finance Brokers Association of Australia, the MFAA, and CAFBA, because I'm not going to say that again, have been partnering with one another to jointly release a new resource for brokers, really about helping SMEs. Now, Charlie, I think you've been ploughing through that resource. What does it include? Why are they doing it?
Yeah, so it's pretty timely. I think as a lot of commercial brokers would be aware that, you know, a lot of businesses are doing it tough, and, you know, got some cash flow issues as rates are rising and costs are increasing. So these two associations kind of on the front foot and you know, describing brokers as you know, more often than not the first points of call that are seeing these pressure points start to develop, and those therefore giving brokers some clearer guidance as to, you know, how to approach this, the conversations to have with these kind of clients. They basically, this new small to medium sized business resource pack for brokers. They build it as a more structured approach to difficult conversations to help clients before the problems harden into, you know, potentially arrears or defaults or that kind of thing. And the key themes basically included encouraging contact with clients as early as possible if, you know, signs of pressure were apparent, or recognizing that business finance and personal finances are usually interlinked or intertwined, and then seeing what you can do about that. Seeing if facilities were structured appropriately, looking out for red flags, and if need be, connecting clients with accountants and bookkeepers. This is part of a broader effort with some other associations, small business associations as well.
Well, I think that's really interesting. And Ben, you've been writing a load about commercial lending and SME lending for the magazine and for a podcast. We've been talking a lot of SME lenders recently. Generally, when you've been sort of talking about all of this, what have been the main pressure points that you're seeing people talk about when it comes to SMEs at the moment?
Well, I guess every SME is different, but it's kind of, on one hand, it's a sort of cyclical pressures. So it's always tax time and wages and that kind of thing. But on the other hand, there's sort of changes to regulation, government changes. I think the incoming Payday Super things are going to have a bit of an impact as well. So I guess in that sense, there is an opportunity for brokers, and that's one of the big themes that sort of comes back to the people I've been talking about. There is an opportunity for brokers to sort of be a little bit proactive and reach out to the SME clients before they are in this sort of real big pressure situation. Because SMEs are so busy, I suppose. Yeah. Every day they're sort of...
Payday Super is a really interesting one. I actually wrote a story for us as a publication, Broker Daily, this week, and it was from ScotPack, and they had done a survey of small business owners, and they found that I think it was 88% of them knew about Payday Super, but less than, I think it was about 68% had not done anything about it in terms of actually preparing their cash flow for it. So this is a big difference, because you have to kind of pay it like pretty much immediately, Super, with the pay run, whereas previously a lot of SMEs would have kind of hold on to it for a little bit, maybe pay it like in the same quarter rather than immediately. So having all of this need, if you've got lots of staff to pay your Super on or around payday, I think it's 7 days it needs to be paid within. But don't quote me on that. I think that will actually really put a lot of bite into people's cash flow. They'll have to have a lot more cash on hand immediately at pay run. Whereas they might not have had that before. They might have been waiting for invoices to be paid. So it's interesting that not that many SMEs have actually looked at their finances and looked at their cash flow or done anything about it. So again, ample opportunity for brokers to reach out and make sure their SME clients are aware. And
100%, and that's one area where brokers can add real value, I suppose, to their clients, because if they haven't sort of thought about this problem, they'll be appreciative if they know
just being like, oh my goodness, I suddenly need to find hundreds of thousands of dollars, depending on the size of your employee stack, like kind of being like, where am I going to get that money from? I'm just not going to eat.
No, it's good to be proactive, I think was the thought line. And that CAFBA and MFAA encouraging brokers to check it out and be on the front foot and be proactive as the cost of things continues to creep up.
And I think it's a good reminder, not just for, obviously a lot of commercial brokers will be doing this day in, day out, but for mortgage brokers who might not have that many SME clients, just as a reminder to be like, here's a resource you can use to have a look at, to be like, are you on top of all of this?
Yeah.
And the other thing I thought was pretty interesting that both CAFA and MFAA were talking about in the resource was also providing helplines. So, sort of charity and mental health helplines, because obviously being a small business owner, when it comes to tightened economic environment, can have a really kind of negative impact on their mental health. So making sure they're kind of prepared that way as well as financially. I think that was a really great inclusion. But yeah, you can find that both on the CAFBA and the MFAA websites if you want to check out the SME, what's it called? Helping small business clients, something like that?
Hang on, let me pull up I'm not sure what it's been labelled.
It's something like helping small business clients.
Yeah, but it is a very useful resource pack for brokers out there.
And of course, like if you have any insight yourself into what you're seeing with small business clients and what kind of issues and preparations they're making for the new financial year, do let us know. We'd love to know. editor@theadvisor.com.au is you can whiz over your sentiments. You can pop them in the comments if you want. We'll take a little look through. But we have been talking to loads of brokers this week, and we continue to do that as we write about the news, as we interview people for the podcasts, and of course as we travel the country for our events. We've recently wrapped up the Better Business Summit and Awards, and coming up later this month we'll be starting the New Broker Academy, which is always really fun, because not only do we get to chat to brokers in their first couple of years, but also people thinking about becoming a broker, which is a lot of fun to meet people who come along, they're thinking about becoming a broker, they're finding out what it takes to be a broker, realizing it's actually quite a bit of hard work, and then kind of getting on their journey. And we love to see, as the years go on, some of those people come back and actually start their broking career and then become elite brokers, including some of our speakers at this year's event. We've got Blank Financial Bernard Desmond speaking this year. And he actually came to New Broker Academy in 2016, I think it was. And I met him then when I was a young thing at the beginning of my broking writing journey, and met him when he was just starting out his broking career. And now he's a major broker, really large brokerage, and kind of doing great things. So we'll be hearing from him. We'll be hearing from Nick Riley from Innovate about how he builds up his broking kind of powerhouse. So what the blueprint looks like that they use at Innovate to get to $100 million, and what sort of training they provide to brokers. Heaps of amazing content. We've got lots of brokers in the different career. Got Joseph Daoud as well from It's Simple Finance talking. Got loads of branded brokers, so Mortgage Choice brokers coming along, and Aussie brokers, and heaps. Nice. So if you are interested in coming along to that, if you're a new broker and you're like, I want to hear how they all do this, I want to learn some more about what kind of things I can be doing to broaden my marketing or diversify, do come along to New Broker Academy. You can find it at newbrokeracademy.com.au. It's coming to Queensland, Victoria and Sydney. Running on the 28th of May is the first one, which is a Thursday, and then the following 2 Fridays, so the 5th of June and 12th of June. It's completely free. So come along. We'd love to see you.
Bonus.
Yeah, absolutely. We'd love to see you all there. And if you've got anything else that you want to know about or find out about, if you've got any gossip for us, do let us know. We're all ears. We love gossip. Charlie, any nice weekend plans?
I've got a couple of gigs which will be nice. I usually do the jazz, but I've got a country western gig.
Oh, exciting!
So gotta
good luck.
Find the Akubra somewhere.
Yeah, an Akubra. Yeah. Get your RMs out.
If only. Yeah, no, I've got boots, so I think I'll be wearing those.
Oh, right.
Yeah, a bit more on brand.
Okay.
Yeah.
And Ben, how about you?
I've got a footy game if my body holds up, and Mother's Day, I believe, is this weekend. Is that right?
Is it? Yeah,
it is
different in the UK than it is in Australia,
yes.
so I'm always confused.
So I have to sort out something for that as well.
Oh.
Yeah, I've got to get my act into gear as well.
Okay, well, that's a PSA, public service announcement for anyone who doesn't know that Sunday is Mother's Day. There you go, off you go. You've got some time to go get your presents.
Yep.
Of course, we'll catch you next time for another episode on the Advisor Podcast Network. We hope you have a fab week.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.